In emerging markets, geopolitics is given a high risk premium. Traditionally, that's not the case in developed markets. Alongside the U.S. presidential elections and the risk of referendum contagion in Europe, over the next 2 years, next to growth and inflation, geopolitics now takes on a larger risk premium in developed markets. So for example, if investors have to determine what the potential fair value of assets are in places like Italy and Spain, and they don't have the backing of the European Currency Union, how are they going to model reverting back to using the lira or the peso? The reevaluation of growth on account of Brexit is also leading to flatter yield curves around the world. It's actually a very powerful phenomenon, if not the most embedded theme in the marketplace right now. There is a high degree of fiscal stimulus being implemented in the world or being discussed or speculated on. On the monetary side, the Bank of England is speculated to be bringing back QE, their funding for lending scheme, rate cuts, and even potentially going to negative rates at some point. There's speculation that the ECB will adjust the capital key or purchase riskier and larger assets as part of their QECB program. And Italy has a bad bank issue. There's speculation that the ECB and the European Union will bend on those rules to help bail that bank system out. And finally, and most importantly, there's a potential for the Fed to recant back to QE. While nobody's calling for it, the concept exists based on what we're seeing at these other central banks. There's plumbing issues that also come back to the fore. There's much greater risk now, especially around illiquid funds that hold real estate linked to the UK. Most people don't realize this, but the UK's twin deficit has a very similar profile to emerging markets. What's held the UK up for over the last decade are the inflows coming from the Middle East and Russia buying their real estate. In the last 3 days, we've seen 4 different fund examples of funds gating redemptions from investors. So even though these funds hold a high cash buffer, it's not easy to go out and sell a real estate investment. What that's doing is it's leading to a minor contagion effect at the banks. The banks also have commercial real estate loans. So whatever's happening in these mutual funds on account of redemptions is also impacting the balance sheet at these banks. The low yields on account of Brexit are also causing investors to believe that equity-like instruments can be similar duration and asset quality-like to bonds. So let me just give you 2 quick examples of that. In Europe, insurance companies may be forced to buy the German DAX because they don't want to buy the absolute negative yields of German bonds. In the United States, we're clearly seeing a growing percentage of S&P 500 companies being bought because they have similar profiles to bonds, very much like Procter & Gamble, Johnson & Johnson, Verizon, AT&T, and the entire utility sector. And then finally, the uncertainty. It could last well into 2017. The reality is that we have elections in France next summer and Germany next summer. Knowing that Germany calls a lot of shots when it comes to the Eurozone, given their own positive balance sheet, it's very much likely that we will have to wait till both of those elections are satisfied. We know who the outcome, and then they help negotiate the exit from the UK with the UK administration. We're stuck with this for quite some time.